some great products that we utilize often for investors. One, let's just assume a property doesn't need major renovation where you need a construction loan. We'll get into construction financing as the second one. But one of my favorite products is something called a DSCR loan. So debt service coverage ratio is the acronym there. And what that loan is, and the reason I love it, is because investors, if you're doing this as a profession or on the side, oftentimes the tax returns are, the tax code is very friendly to investors, let's be honest. So oftentimes the tax returns don't look great as far as qualifying for conventional financing. So a lot of times, if you're an owner occupant, you'd be kind of out of luck. If you want to buy another property and you don't qualify conventionally, there are some creative products, but not nearly as creative as there are for investors. So the beauty of the DSCR loan is that the loan is the approval, with the exception of, having to meet minimum credit requirements and having a little bit of money left over after closing in a reserve. The beauty of it is that the underwriting is primarily based on the cash flow of that property in a vacuum. So if you have cash flow, let's say you're renting for $2,000 a month and your expenses for your mortgage, taxes, and insurance are $2,000 a month as well, and you have decent credit score and a little bit of money in the bank, those loans are going to get approved. It doesn't matter if you have 10 other properties that are all losing money, or if you have if you're retired or are in between jobs or anything like that. They're not looking at employment and traditional income. They're just looking at the cash flow of that subject property by itself. So it doesn't matter what the rest of your finances look like, and if you can qualify more conventionally on what we call a debt to income ratio, which is your income relative to your personal expenses, that's not a factor in these loans. So that's one where you can pull equity out. You can use it to acquire properties. Generally speaking, you can get up to the best rates tend to be with 25% down, but you can go up to 80 and sometimes a little further. But as you go higher, you get higher in rates. So you have to be a little mindful of that. But that's one of my favorite products. Now, in the event you find a property, let's just say it's uninhabitable or it needs a lot of work that you don't want to come out of pocket for, there are what we call fix and flip or fix to rent loans, where basically you build in the majority of the construction costs into the loan. And what the lender will do is they'll build out what we call a draw schedule, which says, okay, once you finish, let's just say it's a major project, you finish framing, they'll give you $20,000 reimbursement for that. And then you finish rough plumbing and they'll give you $10,000 for that. And it's kind of predetermined what schedule they're going to reimburse you for. So you might have to front the money, but then you get it back within a handful of days. So, and those usually don't require nearly as much capital as you might think. Some of the more aggressive programs will finance up to 90% of the acquisition cost and then 100% of the construction costs. So you can really leverage it if you want to. They will do that only if the property value in the future is high enough to justify the amount of financing you'll have long term. So there are some considerations there, but it's a great way to rehab a project. And in my opinion, the rehab is where you can build some sweat equity and really take advantage of market conditions, where a homeowner might not want to buy a house that's uninhabitable and needs $100,000 worth of work, but investors sometimes love those projects.
Yeah.